Hey everyone, and welcome back to the channel. Today, we're diving deep into a truly fascinating and frankly, pretty shocking moment in modern economic history, the Russian default of 1998. It's not every day you hear about a major global power, a superpower even, teetering on the brink of financial collapse. But that's exactly what happened. This wasn't just a blip on the radar, it was an earthquake that sent shockwaves across the world, and it left a lasting mark on Russia itself. So, grab a coffee, because we're going to break down how Russia, just 7 years after the fall of the Soviet Union, found itself in this incredibly precarious position. First, let's set the scene. The early 1990s in Russia were a whirlwind of change, chaos, and economic experiments. But after decades of central planning under the Soviet system, the country was attempting a monumental shift to a market economy. Imagine trying to transform an entire nation's economic DNA overnight. This transition was incredibly painful for many ordinary Russians. We're talking about rampant inflation, privatization schemes that often benefited a select few, and a general sense of instability. The government was struggling to collect taxes, corruption was widespread, and state enterprises, once the backbone of the Soviet economy, were floundering. Essentially, Russia was running massive budget deficits, meaning it was spending far more than it was taking in. To bridge this financial gap, Russia started borrowing heavily, both from international lenders and its own citizens. A big part of this borrowing came in the form of short-term government bonds, known as GKOZ, or asterisk Gосударственные краткосрочные облигации asterisk. Think of them like super high-interest IOUs from the government, designed to attract foreign capital. And attract it they did. For a while, these GKOs offered incredibly attractive returns, luring in foreign investors hungry for high yields. But this was a classic higher risk, higher reward scenario. The higher the yield, the more desperate the issuer usually is, and the more fragile the system becomes if something goes wrong. And boy, did things go wrong. Several factors converged to create the perfect storm in 1998. First, oil prices, which are a huge source of revenue for Russia, plummeted. This immediately hit government coffers hard. Second, there was a growing loss of confidence from foreign investors. They started to get nervous about Russia's ability to pay back its debts, especially with such high interest rates on those GKOs, and adding to the global instability, there was the Asian financial crisis, which had already begun to ripple across markets in 1997. This crisis made investors even more risk-averse and eager to pull their money out of emerging markets like Russia. Capital started fleeing the country at an alarming rate. The Russian government tried desperately to stabilize the situation. They went to the International Monetary Fund, or IMF, for help and secured a massive bailout package. They also tried to implement austerity measures, cutting spending and trying to raise taxes. But none of it was enough to stem the tide of capital outflow and the growing crisis of confidence. The problem was too deep-seated. The government's finances were fundamentally unsound, and the market knew it. They were trapped in a classic Ponzi scheme situation with the GKOs. They needed to borrow more and more to pay off existing bondholders, which was unsustainable. Then came the fateful day. August 17, 1998, the Russian government made an announcement that shocked the financial world. They effectively defaulted on their domestic debt, those GKOs, meaning they wouldn't be paying them back as promised. They also announced a unilateral restructuring of foreign debt and a 34% devaluation of the ruble. It was a triple whammy that sent financial markets into a tailspin. Imagine waking up to find that the money you lent to a major country might not be coming back, and the currency you hold is suddenly worth a third less. The immediate aftermath was chaotic. Banks that had invested heavily in GKOs collapsed. Ordinary Russians saw their savings, which were often held in rubles, evaporate overnight due to the massive devaluation. Supermarkets ran out of goods as imports became prohibitively expensive. There was widespread panic and social unrest. The economic consequences for Russia were severe: a sharp contraction in GDP, soaring inflation, and a major blow to public trust in the government and the financial system. It was a truly dark period for the country, but the impact wasn't confined to Russia's borders. The Russian default had significant global repercussions. Major international banks and hedge funds, which had invested heavily in Russian debt, suffered huge losses. One prominent hedge fund, Long-Term Capital Management (LTCM), which had made highly leveraged bets, including on Russian bonds, almost collapsed entirely. Its failure threatened to trigger a wider financial meltdown, forcing the Federal Reserve in the United States to orchestrate a bailout to prevent systemic risk. This highlighted just how interconnected the global financial system had become. So, what lessons did we learn from this crisis? Well, for Russia, it was a brutal but ultimately clarifying experience. The default forced a painful but necessary restructuring of its economy. The ruble devaluation, while devastating in the short term, eventually made Russian exports more competitive and stimulated domestic production. The government also finally got serious about fiscal discipline, improving tax collection and reducing its reliance on short-term borrowing. This laid the groundwork for a period of economic recovery, especially as oil prices began to rebound in the early 2000s. For the rest of the world, the Russian default served as a stark reminder of the risks of emerging market investments and the dangers of excessive leverage. It underscored the importance of strong regulatory oversight and robust risk management in the financial sector. It also highlighted how quickly confidence can erode and how devastating the domino effect can be in a highly interconnected global economy. It was a wake-up call that even a superpower transitioning to a market economy could face profound financial vulnerability. The 1998 Russian default was a moment of profound crisis, but it also became a catalyst for change. It reshaped Russia's economic trajectory and offered invaluable, albeit painful, lessons for global finance. It's a powerful story of risk, resilience, and the sometimes brutal realities of economic transformation. Thank you so much for watching and sticking with me through this deep dive into the Russian default of 1998. I hope you found it as insightful as I did researching it. If you learned something new or found this video interesting, please hit that like button, share it with a friend, and don't forget to subscribe to the channel for more economic history and financial insights. Your support helps us create more content like this. See you in the next video.